Today we're talking about something that does not get enough airtime. What actually happens to your investments when you die in South Africa? Here's what we'll be covering: unit trusts, shares, retirement annuities, living annuities, tax-free investment accounts, and endowment policies. And if you want a deeper dive into estate duty and capital gains tax, check out our video linked below. It breaks down what the numbers are and how SARS does the calculation on what's owed. Okay, so let's break it down, because when you pass away, your investment don't just magically land in your loved one's bank accounts. There's a process that needs to be followed, and there is tax. And there's a big difference between assets that go through your estate and those that don't. Let's start with unit trust. These go into your estate, and that means when you pass away, your executor takes it over and they'll either sell the units or transfer them to your heirs, but only after the estate is wound up. This can take a couple of months and sometimes over a year. And while that's happening, your family might be waiting for money they need now. Plus, the executor charges a fee, legally up to 3.5% plus VAT. So if you've got 1 million in unit trust, 40,000 can be gone before it gets transferred. Now, retirement annuities. These do not go into your estate. They're governed by Section 37C of the Pension Funds Act. That means the trustees of your retirement fund will decide who gets the money. Not your will, not your executor. They will look at who depended on you financially, your spouse, your kids, maybe even a parent, and they'll allocate the benefit accordingly. You can nominate beneficiaries, but it's more like a suggestion. The trustees have the final say. And here's the good news: no estate duty, no executor fees. That 2 million rand in your retirement annuity will go straight to your dependents. They might pay tax if they take it as a lump sum, but that's a separate issue. But they have the option to transfer to a living annuity on which the income will get taxed. For more information about how the taxes on retirement funds work, check out our video about retirement funds. Tax-free saving accounts are a mixed bag. If your tax-free savings account is structured as a life-wrapped investment, you can nominate a beneficiary. This is usually the better option in my opinion. That person gets the money directly, no executive fees, and that's a relatively quick payout. But if it's just a regular investment account, like with a bank for example, it goes into the estate. That means delays, fees, and estate duty. Either way, the value is counted in your estate for tax purposes. And no, your beneficiary can't just roll it into their own tax-free account. The account ends when you pass away. Endowments are like life insurance with the investment twist. You can nominate a beneficiary and they can get the payout directly, or the contract can get transferred to their name. It's very fast and there's no executive fee. But this is important. SARS will still see this as part of your estate. It's called deemed property. So estate duty applies unless it's going to your spouse. Again, check out the explainer video for how estate duty and capital gains tax works. It's linked below. Now coming to shares, whether it's in a public company or your family business, it will go into your estate. The executor decides whether to sell and transfer them. If you want your kids to keep your shares, say so in your will. Otherwise, they might get sold off to pay debts or taxes. And yes, estate duty applies, capital gains tax applies, executive fees applies. It's the full package. Unless you leave it to your spouse, then you get a rollover and an exemption. Living annuities are post-retirement investment products. You've already retired and you're drawing income from them. So when you die, the remaining capital does not go into your estate. It goes directly to your beneficiaries. They can choose to either take the money as a lump sum, which is taxed, or they can continue the annuity in their own name. No estate duty or executive fees, and the payout is usually quite quick. Just note, on living annuities, there will be a tax if they opt to take the money in cash. This is covered in our retirement video. And there will be a tax on the income if they take it as an income. Okay, so let's walk through this table. This is your cheat sheet. So here's what you're looking for. A green tick in bypass estate means your loved ones will get the money faster. A red cross in estate duty means SARS will not levy that fee. And a red cross in executive fees means no 3.5% fee to the person winding up the estate. I think an important caveat is just here to remember to view all investment planning and estate planning as part of a holistic plan, and not to view any decision in isolation, because that can cause a different set of problems. So, what's the takeaway? Use beneficiary nominations where you can. Keep your will updated. This is very important to make sure your wishes get reflected after you pass away. Plan for liquidity. Your family might need cash before the estate is finalized. And know which assets are tax efficient and which ones aren't. And talk to a financial planner if your situation is complex. They will help you navigate it in the most efficient way. This isn't just about money. It's about making sure your legacy is passed on the way that you intended, with clarity and efficiency, and with as little stress as possible for your loved ones. If you found this video helpful, share it with someone who needs to hear it. And if you want to dive deeper into estate planning strategies, reach out to our practice and we'll unpack it with you. See you next time.